The basic idea behind my research was basically talking about, when you're a mutual fund investor, how do you decide what's the best mutual fund for you? You basically choose either on the basis, you're trying to figure out what's going to deliver returns to you in the future. And you only have two things. You have the style of the fund, what it's actually investing in, and you also have the past performance of the fund. And everybody tells you the past performance is no guide to future performance, but that's one of the markers you have. You hope that the guy has done well in the past will continue doing well in the future. But you also want to know what he's actually investing in. It turns out that mutual funds actually don't have to, the name of the fund doesn't have to have any correlation with what they're actually holding. So for example, if you invest in a growth fund, if you invest in a growth stock, what is a growth stock? You could call Microsoft a value stock or a growth stock. So what we found is several mutual funds, when there are patterns in which growth and value become hot, so that when growth is hot or value is hot, or small is large, or small is hot, they will change their names to call themselves a growth fund, even though they still haven't changed the underlying holdings. So nothing has changed. All they're doing is change the label on the front. So the investors think, well, now growth's hot, I'm going to invest in a growth stock.
I'll bring in Edward. Edward, can I bring Edward Hadders from Reuters? Can I ask you the question whether fund groups are cynical exploiters of investors?
I used to work for a fund group, and you're talking about that. I remember sitting around with a marketing guy from our fund group who said, our slogan is something about how what you see on the label is what you get, that we're very accurate. And there were a bunch of us analysts and portfolio managers who said, but that's not true. We change our portfolio construction all the time in order to match whatever is hot in the market. And the label is very inaccurate. And the guy said, yeah, but people want to be told that what you see is what you get. So we will tell them that. And I felt that was a level of cynicism that was a bit much, even by the standards of the industry, of cynicism. I'm happy to say that group has lost most of its assets, so there is some justice in the world.
Okay, so there is the
But the answer is yes, I think investment managers are pretty
Nicola,
cynical.
to ask you, do you think that success in raising money, fundraising, to get people to invest in funds, does it really mean that you've got to fit the current zeitgeist, you've got to go with a certain herd flow, or is that just rubbish?
Well, a lot of people are actually advised by independent financial advisors in the UK, and they do tend to follow performance trends. So you do find that the fund that did best over the last 2 years is the fund that's getting all the money at that particular moment in time. So there is definitely a herd instinct. And generally speaking, as we all know, that's normally the moment you should be selling a fund, not buying it. There are some people who perform every year, but they're few and far between. Even the very best fund managers have periods of outperformance, then periods of underperformance.
Right.
So you should really be buying the ones where you believe the fund manager is still a good fund manager, but has just been through a period of underperformance, rather than rushing into the one that's just done.
Exact timing is very important.
Timing is important.
Brings us on to Lloyd Raynor from Russell, and you had some interesting thoughts on trying to advise clients to buy funds, and the timing, it can be difficult.
Sure, I mean, the issue is Russell put together manager of manager portfolios, partly to effectively ensure that individual investors don't have the burden of picking managers themselves, because the issue is often you need to have the expertise in place to look under the bonnet, so to speak, to understand the stocks that are actually in funds in the first place. As well as that, it's important to have the right index against which those managers are being measured. So, for example, if you are investing in a value fund, for example, you should have that fund potentially evaluated against a value index, because that allows you to check whether the fund is actually remaining true to its stated investment style.